Hello, we are on page 11 of chapter 9. We just finished doing a fair value through OCI method for equity. And now we're on the last two pages and we're going to look at impairment and then a brief look at significant influence. So, if you have net equipment, okay, so equipment minus depreciation on yours, and it's $100,000, okay? It's old equipment, you've depreciated, it got a lot more wear and tear than you thought, didn't last as long, that kind of thing. The fair value, so what you'd sell it for, what it's worth now, is less than that, okay? Can you leave it on your book? Let's say it's, I don't know, 60,000. Can you leave it on your books at 100? Would that be right? No, you'd have to take it out and decrease it by 40,000, right? The difference between the two? Right? Does that make sense? Okay, that's called impairment. That's what we're going to talk about now, the models to use. So, financial assets, just like this, have to be tested for impairment. Impairments must be recorded at each reporting date. It arises when future cash flows become uncertain. So in this case, our future cash flow couldn't generate even close to 100,000. Maybe that's why you write it down. Okay? Now, that's equipment. That's a different way of measuring it. Here we're looking at financial assets. So the incurred loss model is for ASPE. And the impairment test is carried out only if there's of a possible impairment. So like a trigger event, like a pandemic. Used for all investments measured at cost or amortized cost. You can use an allowance account or reduce the value directly. Impairment losses can be reversed, so later you can write it up. And then you can read indicators of possible impairment. Impairment loss is recognized in net income, difference between carrying amount, and the revised present value of expected cash flows. Okay? So if it was a bond, you take the bond, come in and do the present value, and you use the historic or current market rate as a discount rate. And we're not doing the details in this. You can read that in the text. The expected loss model, we'll do a little more impairment later in the course, but this is just knowing when to use what. The expected loss model is for IFRS. Impairment test is carried out continuously, so you don't have to wait for a trigger event. So it's a little more transparent. It's recognized in net income again as a difference between carrying amount and the revised present value of expected cash flows. Except for losses on FV OCI, as that would go into OCI. Revised present value is calculated cash flow model again, but you use the original effective interest rate with probability factored in. Changes in market interest rate should not be treated as impairment. That would be under unrealized gains or losses. And both use the fair value loss method. And these ones are FV, OCI for equity, and FVNI, and these are going to be automatic. So we'll adjust to fair value without needing impairment check or test. So impairment loss is recognized in net income between the carrying amount and the fair value. It's a loss. If it's a gain, worry about it. If you are using the discounted cash flow model, the current interest rate. For investments valued using fair value at net income, no need to assess impairment. Used for all investments carried at cost, amortized cost, as well as debt investments carried at FVOCI. So currently IFRS allows for a mix of methods depending on the asset. So financial assets, investments at cost or amortized cost, use the expected loss model with the original discount rate. But if it's FVNI and equity investments for FVOCI, you use the fair value model, and you don't need a separate impairment. Debt with FVOCI is the expected loss model. Sorry, I should have added that in. Now, ASPE specifies a mix. Financial asset investments at cost or amortized cost use the incurred loss model with the current market rate. Equity instruments with market values, and derivative instrument, all about derivatives like forward contracts in 316. Anyway, so for equity estimates and derivative instruments, use fair value model. So that's just a little checklist. Your questions in that area will just be multiple choice kind of stuff. Okay, last section that I want to do, but you can read and see examples in your text. When an investor has significant control over another entity, so that's 20 to 40%, it's called an associate, and that's where you buy shares. So under IFRS, you have to use what's called the equity method to account for the investment. Under ASPE, if the shares are actively publicly traded, you can use fair value through NI or equity method. If the shares are not traded, cost or equity method. So this is equity method works, and you're going to see this again in Accounting 410. Increases to the investment account are made when net income of all things is declared by the associate. That's because you own quite a big chunk of that associate, up to 49%. Well, 49.999. And you do have some influence over them. So when they declare net income, you're benefiting from that by increasing your investment. Right? If they declare net income, it increases the investment account. And of course, decrease if there's a loss. Now, if you get dividends from them, normally dividends are good, right? But think from the company's perspective. If you give away all your cash, yes, it keeps your investors happy, but does your company have that money to use to build it and improve its efficiency and stuff like that in the next few years? Further investment? No, you don't. So you actually decrease the investment account when they give you dividends. Okay. Again, you're focused on, wow, you have quite a bit of stake in this company and a little bit of sway and influence because you own so much. So when they give away the dividend, it's reducing your investment because your balance sheets dropped. Their balance sheets dropped. Okay? So it's not testable in this course. I just kind of wanted to introduce it so it's not such a shock next semester or next year. Okay, and here's your suggested problems, your extra problems, and hopefully this will make sense. Okay, so that's the end of chapter 9, and I hope it goes well. Bye.